Welcome to Wealth Pathway here. We don't chase noise, we only capture signals. Now, I want to ask you a question. When you stare at that constantly jumping spot silver price on your screen, watching it oscillate, plunge, and then weekly rebound, do you feel a kind of inexplicable anxiety in your heart? This sense of anxiety even makes you start doubting your own judgment. Did I get it wrong? If the fundamentals are so good, why is the price still falling? Does this really make sense? Listen to me, this anxiety is normal. But it is not because you are wrong, quite the opposite. This is this is your rational mind trying to reject a false narrative. When the market fluctuates violently, the human reptilian brain instinctively seeks shelter and familiarity. So, you stare at the candlestick charts, you stare at the Fed's interest rate decisions, and you ask that extremely mediocre question, has the price dropped too much now? Is it time to buy the dip? At this moment, focusing on price fluctuation itself is a huge trap. It is like the Titanic has already hit the iceberg. Yet you are still on deck arguing whether the first-class dinner menu has gone up in price. The real risk is never volatility. Volatility is just the rhythm of the market breathing. The real risk lies in assumptions. At this very moment, in every corner of the global financial market, from Wall Street's top investment banks to retail traders' accounts, people are operating based on a series of default assumptions about the silver market. They assume the market is like tap water, turn it on and it flows. They assume liquidity is like gravity, eternally present. They assume paper contracts can be exchanged for heavy metal at any moment. These assumptions in calm and peaceful times hold true. They make the financial machine run smoothly and efficiently. But, my friends, we need to clearly realize we are no longer in a calm and peaceful cycle. We are entering a high-pressure era of global credit system fragmentation, supply chain restructuring, and geopolitical fracturing. In this era, those old-world assumptions that make you feel comfortable are precisely the graves that will bury your wealth. Today, we are going to dismantle 7 deadly mental misconceptions. These 7 misconceptions are blinders carefully woven by Wall Street. If you can't take them off before the crisis fully erupts, you won't just lose profits, you'll lose your chips for survival. Let's start with the most common misconception. People tend to view resource scarcity as a binary event, like a light switch on the wall, either on or off. Either you have silver or you don't. Either the vault is full or empty. This way of thinking is extremely naive. The operating logic of physical markets isn't binary code. It is an analog signal filled with gradients, friction, and gradual processes. If you expect to see global silver inventories drop to zero overnight, or a giant sold-out sign posted on a Mint's website before you believe a shortage has occurred, you'll never catch the opportunity, because by the time you see that sign, the game is long over. How does a real shortage happen? It is a process of constantly escalating friction gradient. It begins with slight tremors at the periphery of the supply chain. At first, you just notice delivery times go from 2 days to 2 weeks. Then you find that premiums on certain specific sizes of silver coins or bars start to decouple from spot prices and rise independently. Even when paper prices are falling, the cost of getting physical metal in hand keeps rising. That is the signal. Next, wholesalers start implementing rationing on retailers. This means even if you have money, you can't buy the quantity you want. This is a form of hidden capital control. At this stage, the market begins to stratify. Insiders with top-tier connections and large institutions can still get metal through contracts, while retail investors at the bottom of the food chain only get a cash settlement. Notice this is a polite legal term that means, sorry, the stuff's gone. Here is your paper money. Now fuck off. From a global macro perspective, there is of course still silver above the Earth's surface. The world hasn't physically exhausted this element, but the core of what we're discussing isn't existence, it is availability. Can that silver be mined at current prices? Can it be refined in time from 1,000-ounce industrial bars into the retail specifications you need? Can it cross those increasingly closed borders and be delivered to your vault? Can it be delivered before modern logistics systems collapse? These are the real questions. A shortage isn't an instantaneous event. It is a process like a python, strangling its prey, slow, quiet, but irreversible. If you are still waiting for official confirmation during this process, you are the prey being strangled. This leads to a second, even more deadly mental trap, confusing owning physical with owning price exposure. In the highly sanitized greenhouse of modern finance, we've been trained to believe that the numbers on the screen are the assets themselves. A futures contract, an unallocated account, a share of an ETF, they seem equivalent to that piece of metal sitting in a safe because they all track the same price. Right? In peacetime, this is not only correct, but efficient, but in turbulent times, this is a deadly counterparty risk. The entire structure of the LBMA and COMEX is built upon a massive unspoken behavioral assumption. 99% of participants will never demand physical delivery. This is a carefully designed game of musical chairs on this dance floor. There are 500 people dancing, but there is only one chair in the middle that is physical silver. As long as the music that is liquidity keeps playing, as long as everyone is just here to earn fiat currency spreads and exits through cash settlement, the system works perfectly. Everyone thinks they own that chair in finance. This is called rehypothecation. Every ounce of physical silver may have been pledged 100 times along the financial derivatives chain, sold to 100 different people. But we are witnessing a paradigm shift in global investor behavior patterns. This shift is a thrilling leap from chasing return on capital to chasing return of capital. When banks fail one after another, when sovereign debt becomes unsustainable, smart money starts to realize if you can't hold it in your hands, you don't own it. The silver market, compared to the gold or bond markets, it doesn't need millions of people to make a run on it simultaneously, just a few large family offices or a few industrial giants panicking about future supply chains, deciding to exchange their paper silver for real silver and ship it back to their own warehouses. And the arithmetic logic of the entire paper pricing mechanism will collapse instantly. When at this moment, you are still content holding paper exposure, you are actually betting that this music will never stop. But in my view, the music has already started going out of tune. Building on this foundation, we need to examine the third misconception, which is your obsession with spot price charts. The vast majority of analysts will tell you that charts contain all the information, but during periods of extreme supply-demand mismatch, spot price is no longer a price discovery mechanism. It becomes a smokescreen that conceals the truth. This is why you see this absurd spectacle. The silver price on the screen is dropping, but when you want to buy physical, you have to pay a 30%, 40%, or even higher premium. What does this tell us? It tells us the spot price has become distorted. What it reflects is the game of paper contracts, the result of algorithmic high-frequency trading, not the true representation of physical supply and demand. If you want to see the future in this market, look away from the center of the screen and look at the edges. Look at the spread between the Shanghai Gold Exchange and the London market. When Eastern market prices are consistently higher than the West, this is evidence that physical metal is flowing eastward. Look at the structure of the futures curve. When backwardation occurs, when the current spot price is higher than futures prices, the market is screaming, "I want the metal now, I don't want promises." This is usually an early warning signal of extremely tight inventory, but algorithms tend to overlook this. Also pay attention to those more hidden signals. When a national mint announces a delay in new coin releases, citing dye issues, or staffing shortages, learn to read between the lines. This is usually a euphemism for lack of silver blanks. When a major precious metals retailer limits daily transaction amounts citing managing volatility, what they're really saying is, we don't dare sell to you at this price because we can't restock at this price. These are the infrasonic waves before an earthquake. The spot price is often the last indicator to react. By the time the candlestick chart finally shoots straight up, that is not the beginning of a rise, that is the door closing. This brings us to the fourth misconception, which is also where basic economics textbooks fail in the face of the real world. Believing that supply is elastic, meaning high prices necessarily bring high supply. The ordinary commodity logic is, if the price rises to $50 or $100, miners will mine like crazy and new supply will flood in like a tidal wave, thus suppressing prices. This is ignorance of geology and metallurgy. You need to understand a core attribute of silver. It is a byproduct metal. About 70 to 80% of the world's silver isn't mined from silver mines. It is a byproduct of mining lead, zinc, copper, and gold. This means silver production doesn't primarily depend on the price of silver, but on the global economy's demand for copper, lead, and zinc. Let's walk through this terrifying logic chain. If the global economy enters a recession due to high interest rates and debt crises, demand for industrial base metals will plummet. Copper and zinc mining operators will slash production or even shut down mines. What is the result? Even if silver prices skyrocket through the roof, silver supply will actually decrease, because when the host dies, the parasite can't survive either. This is the reflexive feedback loop. Furthermore, due to the global obsession with ESG issues over the past decade and the demonization of traditional extractive industries, capital expenditure in the mining sector has been severely inadequate. To explore, permit, construct, and bring a new primary silver mine into production today takes an average of 10 to 15 years. This isn't writing code. You can't pull all-nighters to rush the progress. This is a hard constraint of the physical world. We've artificially severed the upstream blood supply, yet expect miracles to happen when demand explodes. Friends, you can't print silver with a money printer, and you can't generate silver with AI algorithms. The supply side cliff is real, and it is rigid. This naturally brings us to the other end of demand, which is the fifth misconception, believing that industrial demand is rational. When prices go up, they'll buy less. Dead wrong. Silver is no longer just for making cutlery or film. On the 21st century's tech tree, silver is irreplaceable blood. It is the core of the conductive paste in your rooftop solar panels. It is the key to high-performance chip packaging in AI data centers. It is an essential material for 5G base stations, high-voltage connectors in electric vehicles, and even the guidance systems of modern kinetic weapons. For an electronics giant or a defense contractor, silver accounts for an extremely small portion of their final product cost, maybe just a few cents in a smartphone, a few dollars in a missile. But without that tiny bit of silver, the entire product can't function. This is what economists call inelastic demand. If you are Apple, or if you are Lockheed Martin, would you stop buying when silver prices double? Of course not. Not only would you not stop, you'd actually panic hoard. Because for industrial users, what is most expensive isn't high-priced silver, but production line shutdowns caused by having no silver. The loss from 1 hour of production stoppage could be as high as millions of dollars. In comparison, the cost increase from rising silver prices is a drop in the bucket. We're witnessing a fundamental shift in global supply chain management philosophy from just-in-time production that pursues ultimate efficiency to just-in-case that pursues survival security. When procurement managers smell a shortage, they'll overdraw future demand in advance and build up massive safety stockpiles. This behavior will push the demand curve steeply up and to the right. Industrial users aren't speculating, they're saving their own lives. This kind of buying can't be deterred by any price. When we zoom out even further, we see the sixth misconception: ignoring the return of history. People naively assume that global trade is still flowing freely. We must acknowledge that globalization is dying, replaced by the rise of resource nationalism. Although silver is produced in Peru and Mexico, the world's major refining and processing capabilities are concentrated in a few specific nodes, especially in the East. If the geopolitical rift between the West and the BRICS nations continues to widen, if de-dollarization accelerates, silver, as a strategic, non-sovereign monetary asset, will become a bargaining chip in this game. Imagine if a major refining power, to secure its own green energy transition or military industrial needs, suddenly announces export controls on silver, or raises export tariffs, or classifies it as a national strategic reserve and bans its outflow. This isn't fear-mongering. We've already seen precedents with critical minerals like gallium and germanium. When this trade iron curtain falls, the West's supply chain will go into instant shock at that point. Global inventory data will become meaningless. Even if warehouses in Shanghai are piled high with silver, if you are in New York or London and can't obtain an export permit, then for you, that inventory equals zero. The pressure in the physical market first manifests as disruptions in logistics and policy, and only later in price. In this fractured world, location is just as important as ownership. Finally, we must confront the seventh and most fatal misconception. You naively believe that the exchange's rulebook exists to protect you. Wake up, the rules are made by the casino, and they exist to protect the house. When the pressure in the silver market becomes great enough to threaten systemic safety, enough to push several too-big-to-fail banks to the brink of bankruptcy, what do you think regulators and exchanges will do? They won't let the market clear freely. They'll change the rules. We don't need to guess. History has already given us the answer. Look at the 2022 London Metal Exchange nickel futures short squeeze. When price movements became disorderly enough to bankrupt a certain tycoon, the exchange simply pulled the plug, canceled billions of dollars in trades, and declared that day's trading didn't count. This is force majeure. If your investment strategy is built on the fantasy of "I can go long on futures contracts and force the house to hand over physical metal during a crisis," then you are not just investing, you are gambling. In a systemic crisis, you won't get silver. You'll receive a check, a fiat currency check settled at the fair prices determined by the exchange. And that price will be far below the real black market physical price. This is the so-called cash settlement trap. This system was designed with one purpose: to prevent physical metal from actually being withdrawn. If you are counting on the rulebook to save you a lifeboat when the Titanic is sinking, you really don't understand how this world operates. Friends, after hearing these 7 misconceptions, my purpose is not to create panic. Panic is cheap, it is a product of emotion, and often leads to wrong decisions. What I want you to have is foresight. Foresight is rational, calm, and preemptive. The current market is offering you a highly asymmetric historical window. Silver's price is still being firmly suppressed by paper leverage, while the fundamentals of the physical world, geological depletion, industrial rigid demand, geopolitical fragmentation, are screaming deafeningly. This divergence is the opportunity for wealth transfer. But you must be clear about your purpose. If you are just trying to make a little fiat currency profit to buy a new toy, then go ahead and keep surfing the paper market, set your stop loss, and good luck to you. But if your purpose is to hedge against systemic risk, to preserve your purchasing power through the coming decade's inflation tsunami and currency reset, then please treat silver as property, not a trading ticker. At this stage, paying a little premium to acquire physical isn't a loss. It is the insurance premium you pay for zero counterparty risk. It is your ticket to reality in this world built on debt bubbles and digital illusions. Don't let the charts deceive you. The storm isn't coming. The storm is already here. It is just that the cracks in the dam are still underwater. and most people are still busy picking up seashells on the shore. This is Wealth Pathway. We walk through the wilderness where most people dare not venture, just to help you draw that map leading to the truth. Stay sober, stay liquid, and most importantly, stay real.